Many older homeowners spend years carefully budgeting for retirement, only to discover that one expense keeps increasing no matter how disciplined they are with money: property taxes. For millions of retirees across the United States, that annual bill has quietly become one of the most difficult ongoing housing costs to manage. And what surprises many people is that there are legitimate senior property tax relief programs available in many states that can sometimes reduce part of that burden. The problem is that a large number of homeowners either never hear about these programs, misunderstand how they work, or assume they automatically apply once they reach retirement age. If you own your home and you are over the age of 60, this is a good time to take a careful look at your most recent property tax bill and learn what options may exist in your state or county. Programs vary widely depending on where you live, and not every homeowner will qualify, but understanding the system could potentially help you avoid paying more than necessary over time. One important thing to understand right away is that property tax rules are local. Counties and states create their own eligibility requirements, deadlines, income limits, and application procedures. Some areas offer generous exemptions for seniors, while others provide smaller forms of assistance. In many cases, these benefits are not applied automatically. Homeowners usually need to research the program, submit documentation, and renew paperwork when required. That is why so many people miss out. It is not necessarily because anyone is hiding information from them. In many cases, local governments simply expect residents to seek out the programs themselves. Unfortunately, many seniors do not realize they may qualify until years later. Today, we are going to walk through the major types of senior property tax relief programs that exist in many parts of the country, the common requirements attached to them, the mistakes that can cause homeowners to lose benefits, and the practical steps you can take to check what may be available in your area. One of the biggest misconceptions about property taxes is that they remain relatively stable once a mortgage is paid off. In reality, property taxes are often tied to the assessed value of a home, and those values can change over time depending on local real estate markets and county assessment practices. Over the last decade, many housing markets across the United States have experienced substantial increases in home values. In some communities, homes that were once modestly priced are now worth far more than they were years ago. While rising property values can increase home equity, they can also lead to higher tax assessments. For working households with rising incomes, these increases may be manageable. But for retirees living primarily on Social Security, pensions, retirement savings, or fixed income sources, yearly increases in property taxes can become increasingly difficult to absorb. Many seniors planned carefully for retirement. They paid down mortgages, maintained their homes, and expected housing costs to become more predictable later in life. Instead, some discovered that even after the mortgage is gone, property taxes, insurance, utilities, and maintenance costs continue climbing. This is one reason lawmakers in many states created programs specifically aimed at helping older homeowners remain in their homes longer. These programs are not identical everywhere, and eligibility requirements differ significantly, but there are several broad categories that appear repeatedly across the country. The first and most common type is the senior homestead exemption. A homestead exemption generally reduces the taxable value of a primary residence before taxes are calculated. Many states already offer standard homestead exemptions for homeowners, but some provide enhanced versions specifically for seniors. For example, if a county assesses a home at $300,000 and a qualifying senior receives a $25,000 exemption, taxes may only be calculated on $275,000 of assessed value instead of the full amount. The exact savings depend on the local property tax rate. In some states, the savings may be relatively modest. In others, they can be more substantial. Eligibility usually depends on age, residency status, and whether the home is considered the owner's primary residence. Many programs begin at age 65, although some states allow eligibility at 62 or earlier. One important detail many homeowners overlook is that homestead exemptions often require an application. Some counties automatically continue the exemption once approved, while others periodically request updated information or verification documents. Another major category is the Senior Property Tax Freeze or Assessment Limitation Program. These programs are designed to limit how much a qualifying homeowner's taxable property value can increase over time. The details vary widely depending on the state. In some locations, the assessed value of the home may effectively be frozen once the homeowner qualifies. In others, annual increases may be capped at a low percentage. Either way, the purpose is similar: to help protect seniors from rapidly rising assessments caused by increasing market values. This can become especially important in neighborhoods where home prices have appreciated dramatically over time. A retired homeowner may have no intention of selling their property, yet still face growing tax bills tied to surrounding market activity. Many freeze programs include income limits. Depending on the state, total household income may need to remain below a certain threshold to qualify. The calculation of income can also differ. Some programs include Social Security income, retirement distributions, pensions, investment income, or other sources, while others exclude certain benefits or medical expenses. Because these rules vary so much, it is extremely important not to rely on generalized advice from videos or social media alone. The best approach is always to verify eligibility directly through official state or county sources. A third category that exists in several states is the Property Tax Deferral Program. This option works differently from exemptions or freezes. Instead of permanently reducing taxes, a deferral program allows qualifying homeowners to postpone paying part or all of their property taxes until a later event, such as the sale of the home or transfer of ownership. These programs are often designed for seniors who have substantial home equity but limited monthly cash flow. In other words, a homeowner may technically own a valuable property but still struggle to comfortably pay rising annual tax bills from retirement income alone. Under a deferral arrangement, unpaid taxes are typically recorded as a lien against the property and may accrue interest over time. The balance is eventually repaid when the property changes ownership or under other conditions established by state law. This type of program is not the right solution for everyone, and homeowners should understand the long-term financial implications before enrolling. However, for some retirees facing immediate cash flow pressure, it can provide temporary breathing room while allowing them to remain in their homes. It is also important to compare deferral programs carefully against other financial products or borrowing options. In some situations, consulting a qualified financial professional or estate planning attorney may help homeowners better understand how a deferral could affect future inheritance plans or overall retirement finances. The fourth category commonly discussed is the circuit breaker tax credit. The name comes from the idea of preventing property taxes from becoming an excessive financial burden relative to household income. Under these programs, homeowners whose property taxes exceed a certain percentage of income may qualify for credits or refunds. Some states apply these credits directly through income tax filings. Others use separate application systems. In certain locations, renters may also qualify for related relief programs because property taxes can indirectly influence rental costs. Again, the details vary tremendously depending on where you live. Some programs are refundable, meaning homeowners may receive money back even if they owe little state income tax. Others simply reduce future tax liability. For seniors living on fixed incomes, even a few $100s in annual relief can make a meaningful difference when combined with rising costs for healthcare, insurance, food, and utilities. Now, while these programs can be helpful, there are several common mistakes that often prevent eligible homeowners from receiving benefits. One of the most frequent issues is missing deadlines. Many property tax programs operate on strict application schedules. Some deadlines occur early in the calendar year, while others vary by county or state. Missing a filing deadline can delay eligibility until the following tax year. This is why organization matters. Once you identify a program you may qualify for, Write down the deadline immediately, set reminders on your phone or calendar, and begin gathering documents well before the due date. Another common problem involves ownership or title changes. For example, if a spouse passes away, a property is transferred into a trust, or ownership is modified for estate planning reasons, the change can sometimes affect exemption status. In certain situations, counties may require updated paperwork to keep the benefit active. Many homeowners assume the exemption will automatically continue no matter what changes occur, but that is not always the case. If anything significant has changed regarding ownership records, it is worth contacting the local assessor's office to confirm the status of existing exemptions. A third issue involves annual verification requirements. Some programs, particularly income-based benefits, require homeowners to periodically confirm continued eligibility. Counties or state agencies may request updated income documentation, residency verification, or additional forms. Unfortunately, these notices sometimes arrive in very plain-looking envelopes that are easy to overlook or mistake for routine mail. Ignoring them can result in suspended benefits or delays. Developing the habit of opening all mail related to taxation, property assessment, or county government offices promptly can help avoid unnecessary problems. Another important point that deserves attention is the difference between online advice and official information. There are many videos, articles, and social media posts discussing senior tax relief programs, but not all of them provide accurate or up-to-date guidance. Some exaggerate potential savings or imply that every senior automatically qualifies for large reductions. That is simply not true. Eligibility depends on local law, income, residency, age, disability status in some cases, and several other factors. Some programs are generous, while others offer limited assistance. Homeowners should always confirm details through official government sources or qualified professionals rather than relying entirely on internet content. That does not mean the programs are unimportant. In fact, for eligible seniors, they can provide meaningful long-term savings. But it is essential to approach the subject realistically and with accurate expectations. Another factor that many retirees underestimate is how quickly even small yearly increases can add up over time. A property tax increase of a few $100s may not seem overwhelming in a single year, but when those increases continue year after year throughout retirement, they can place significant pressure on a fixed monthly budget. This becomes especially difficult for homeowners dealing with rising healthcare costs at the same time. Prescription medications, insurance premiums, specialist visits, and long-term care planning are already major concerns for many retirees. When property taxes continue climbing alongside those expenses, financial stress can build quietly in the background. Some seniors eventually begin making difficult trade-offs. They delay home maintenance, postpone medical appointments, reduce travel plans, or cut back on social activities in order to keep up with household costs. That is why understanding available relief programs matters, even if the savings are not enormous. Sometimes a few hundred or a few $1,000s per year can ease pressure in ways that meaningfully improve quality of life. It is also important to understand that some relief programs are tied to residency duration. Certain counties or states provide enhanced protections for homeowners who have lived in the same property for a long period of time. Others may offer additional support for disabled seniors, veterans, surviving spouses, or low-income households. Because these rules vary so much, homeowners should avoid assuming that one person's experience automatically applies to another. A neighbor in the same community may qualify for a program that someone else does not, based on age, income, ownership structure, or local regulations. Another thing worth discussing is reassessment notices. Many homeowners receive property assessment letters in the mail and immediately assume nothing can be done. In reality, some assessments contain mistakes. Incorrect square footage, outdated property information, or inaccurate comparisons can occasionally affect valuations. That does not mean every assessment is wrong, but it does mean homeowners should review notices carefully instead of ignoring them. If something appears inaccurate, there is often a formal process to ask questions or request a review. Deadlines for appeals are usually very strict, so waiting too long can remove the opportunity to challenge the assessment for that year. Some retirees also choose to downsize specifically because of rising property taxes and maintenance costs. For certain households, moving to a smaller property or lower tax area can improve long-term financial stability. But for others, remaining in a long-time family home is deeply important, emotionally and financially. That is exactly why many senior tax relief programs were created in the first place. Policymakers recognized that older homeowners should not necessarily be forced out of homes they have lived in for decades simply because surrounding property values increase dramatically. At the same time, homeowners should approach all financial decisions carefully. Property tax relief programs can help, but they are only one piece of retirement planning. Long-term budgeting, healthcare planning, emergency savings, estate planning, and debt management all remain important parts of financial stability later in life. So what practical steps should homeowners take if they want to explore available options? First, start with your state's Department of Revenue, Department of Taxation, or county assessor website. Most states maintain online pages explaining available exemptions, freezes, credits, or deferral programs for seniors. Search using terms like senior homestead exemption, senior property tax relief, property tax freeze, or circuit breaker credit followed by your state name. Second, gather important documents ahead of time. Many applications require similar paperwork, including proof of age, proof of residency, proof of ownership, and income documentation. This may include a driver's license, utility bills, Social Security benefit statements, pension documentation, tax returns, or property deeds. Having these materials organized in advance makes the application process much easier. Third, keep copies of everything you submit. Whether filing online, by mail, or in person, maintain records of applications, confirmation numbers, receipts, and correspondence. If an issue arises later, having documentation can help resolve disputes more efficiently. Fourth, pay attention to renewal requirements. Some programs renew automatically once approved, but others require annual or periodic updates. Do not assume the benefit will continue indefinitely without verification. Fifth, consider asking questions directly. County assessor offices may be busy, but many employees are willing to explain available programs, deadlines, and eligibility requirements if contacted respectfully and prepared with basic information. It is also worth mentioning that property taxes are only one part of the broader retirement affordability picture. Many older homeowners are simultaneously dealing with rising insurance premiums, maintenance expenses, healthcare costs, prescription prices, and inflation affecting everyday necessities. Because of this, even moderate tax relief can help create additional financial flexibility. Savings may go toward medication costs, home repairs, groceries, transportation, or simply reducing financial stress during retirement. At the same time, homeowners should remain cautious about anyone promising unrealistic outcomes. No legitimate program completely eliminates all property taxes for every senior homeowner, and claims suggesting otherwise should be viewed carefully. There are also occasional scams targeting older adults related to property taxes and exemptions. Some companies charge unnecessary fees to help seniors apply for programs that can often be accessed directly through county offices for little or no cost. Before paying anyone for assistance, verify whether the forms and applications are already available for free through official government agencies. Another area of confusion involves assessed value appeals. In some cases, homeowners may believe their property has been assessed at an unreasonably high value compared to similar homes nearby. Most counties provide some type of appeal process that allows homeowners to challenge assessments if they believe errors were made. Deadlines for appeals are usually strict, and evidence such as comparable home values may be required. An assessment appeal is different from a senior exemption, but in certain situations, both approaches may help reduce overall tax burdens. For seniors who feel overwhelmed by paperwork or online systems, asking a trusted family member, financial advisor, tax preparer, or community organization for help can make the process easier. Many local senior centers and nonprofit organizations also provide assistance during tax or benefit enrollment seasons. The important thing is not to ignore the issue entirely. Many homeowners assume nothing can be done about rising property taxes, but depending on where they live, there may be programs worth investigating. Even relatively small yearly savings can add up significantly over a long retirement. And while no single program will solve every financial challenge retirees face today, understanding available options is still worthwhile. One thing that often surprises people is how different neighboring states can be. Two homeowners with similar incomes and similar homes may receive very different forms of relief simply because they live under different state tax systems. That is why broad national advice can only go so far. The real answers usually come from local rules and county-specific guidelines. It is also important to understand that laws change over time. States sometimes expand programs, adjust income limits, change eligibility ages, or modify exemption amounts. What was true 5 years ago may not be accurate today. Checking official resources periodically helps ensure you are working with current information instead of outdated assumptions. If you are helping parents, relatives, friends, or neighbors navigate retirement finances, property taxes are one of those subjects worth discussing openly. Many seniors quietly worry about rising housing costs but never bring it up in conversation. Sometimes a simple discussion about available programs or deadlines can encourage someone to look into benefits they did not realize existed. And even if a homeowner ultimately does not qualify, taking the time to verify eligibility provides clarity and peace of mind instead of uncertainty. The larger lesson here is that retirement planning does not end once someone stops working. Financial management during retirement still requires periodic review of expenses, benefits, tax obligations, and available assistance programs. Property taxes may feel like a fixed and unavoidable expense, but in many cases, there are legitimate ways to reduce, defer, or manage part of the burden depending on local law and personal circumstances. The key is being proactive rather than assuming everything happens automatically. Take some time this week to review your most recent property tax bill carefully. Check your county or state website. See whether your area offers senior exemptions, freezes, credits, or deferral options. Write down any deadlines that apply. Even if the savings are modest, every dollar matters when managing retirement income carefully over the long term. And if you know another homeowner who may benefit from learning about these programs, consider sharing this information with them as well. A simple conversation could encourage someone to ask questions, verify eligibility, and potentially reduce an expense that has been steadily growing for years. Take care of your finances, stay informed about local programs, and make decisions based on verified information from trusted sources. That approach will always serve you better than reacting to fear, rumors, or exaggerated claims online. This is Golden Seniors Hub, and the goal is simple: helping older Americans better understand the financial systems that affect retirement life so they can make informed and confident decisions for the future.